You finally have $500 left over at the end of the month. And you open 5 different tabs. One says max your Roth IRA. One says pay off debt first. One says buy index funds. One says crypto is the move in 2026. One says just save cash. The market's about to crash. 5 confident voices, 5 completely different answers, and you're no closer to knowing what to actually do. So you do what most people do. Nothing. The money sits in checking, earning basically zero, while you wait to figure out the right order. My name is Nick, and today I'm giving you the exact order, step by step, for where your money should go in 2026, regardless of how much you're starting with. Step 1 isn't investing at all. It's a small starter emergency fund. Not the full 6 months everyone talks about, just $1,000 to $2,000 sitting in a basic savings account. Without this cushion, the first car repair or medical bill forces you onto a credit card at 22% interest. This isn't an investment. It's the insurance policy that protects every investment decision you make after it. Step 2. If your employer offers any kind of retirement match, contribute exactly enough to get the full match. And not $1 more yet. A 50% match on your contribution is an instant 50% return before the money has even touched the market. There is no investment on earth that reliably beats free money matched against your own. Skipping this step to pay extra on a 4% interest rate debt is mathematically backwards. Step 3. Attack high-interest debt, anything above roughly 7%, which usually means credit cards. A credit card charging 22% interest is a guaranteed 22% loss every single year you carry a balance. No stock market index has reliably returned 22% a year over time. Paying off the debt is the highest, safest, most guaranteed return available to you anywhere in your entire financial life. Step 4. Now build out the emergency fund the rest of the way. 3 to 6 months of essential expenses in a high-yield savings account. This is the step people skip to chase bigger returns, and it's the step that causes them to sell investments at the worst possible moment. A fully funded emergency fund is what lets every dollar after this point stay invested through market drops instead of getting pulled out in a panic. Step 5. Max out tax-advantaged retirement accounts, a Roth IRA or traditional IRA, and increase your 401k contribution beyond just the match. These accounts aren't separate investments. They're tax wrappers around the investments you're going to make anyway. The same index fund inside a Roth IRA can grow completely tax-free for decades, compared to that same fund sitting in a regular taxable account getting taxed on dividends and gains every single year. Step 6. Now address lower interest debt, student loans, a car loan. Anything sitting in that 4% to 7% range. This is genuinely a judgment call. Paying it down guarantees you that interest rate as a return. Investing instead gives you a historically higher, but less certain return. There's no universally correct answer here, but it should come after your tax-advantaged retirement accounts are funded, not before. Step 7. Once retirement accounts are maxed and lower debt is under control, open a regular taxable brokerage account and invest consistently, typically into broad, low-cost index funds. This is where money goes once you've exhausted the tax-advantaged space. It has none of the special tax treatment, but it has no contribution limits and no withdrawal restrictions either. This is the long-term wealth-building engine for money beyond what retirement accounts can hold. Step 8, and only Step 8, is speculative investing. Individual stocks you believe in, real estate beyond your home, cryptocurrency, anything higher risk and higher variance. This comes last because it should only ever be money you can genuinely afford to lose without changing your life. If your foundation is built first, speculation becomes an interesting bonus. If it comes first, it becomes a gamble with your actual financial future. A few notes specific to where things stand in 2026. Interest rates have shifted meaningfully over the past few years, so that 7% threshold isn't fixed forever. It's worth checking current rates rather than assuming the old numbers still apply exactly. Contribution limits for retirement accounts also adjust most years for inflation. So the specific dollar caps on your 401k and IRA in 2026 are higher than they were even a few years ago. Worth checking the current limits rather than working from outdated numbers. High-yield savings rates have moved around significantly in recent years. The accounts paying close to nothing back in 2021 are a completely different landscape now. It's worth actually shopping for a competitive rate on that emergency fund instead of leaving it in whatever account it's always been sitting in. Here's the thing almost nobody emphasizes enough. The specific fund you choose inside Step 7 matters far less than whether you actually completed Steps 1 through 6 first. Someone who diligently follows this order with a simple, boring index fund will almost always end up wealthier than someone who skips the emergency fund. To chase a hot stock tip with their first $500. The sequence does more heavy lifting than this election. This is the part that's genuinely hard to accept when you're excited about investing for the first time. The boring foundational steps feel like they're delaying the fun part. But they're not delaying it, they're protecting it. Every dollar that skips ahead of this order is a dollar exposed to getting wiped out by something completely preventable. So back to that $500 sitting in your checking account. Here's what actually happens with it tonight, depending on where you are. If you don't have $1,000 saved yet, that money goes straight into a basic savings account. Full stop. If that's already covered and your employer offers a match you're not fully claiming, redirect your next paycheck contribution. If you've got high-interest debt sitting on a card, that $500 goes straight at the balance. You'll likely never find a safer 20% plus guaranteed return anywhere else in your life. If all of that is already handled, that $500 finally gets to do the fun part. Into a Roth IRA, into an index fund, building the wealth you actually started this whole search to build. The order isn't complicated once you see it laid out. It's just rarely laid out clearly, because 5 different financial voices are usually each selling you their own step. As if it's the only one that matters. It's not the only one. It's just one step in a sequence. And the sequence is what actually builds wealth. Closing, full staircase recap, final wide shot. Closing, host and female professional both beside the staircase. End card, channel brand.